Hello, welcome to this video on financial markets. So when you think of the term financial markets, you might think of the stock market with share prices and lots of flashy numbers. Actually, financial markets are more than just that. And in this video, we're going to look at the different roles of financial markets. And there's 5 roles that we're going to look at how financial markets play a role. And these are the 5 that we're going to look at. More broadly speaking, financial markets are ways in which investors, sometimes we call lenders, so people who have money and want to save it or invest it, can be connected with borrowers, so maybe governments or companies who want money to be able to expand or pay for public services. And financial markets are those banks and other financial institutions, some examples here, that help connect the two. If you lend your money to a company, you don't normally go around and give it to them through the door. You put it into a bank and they make that loan in turn. So let's start off with the first role of financial markets, and that's to facilitate saving. Now, if you were a bit concerned about banks, you might decide to keep your money under your mattress when you earned it from work. But the problem with that is that if prices start to rise and your money is not increasing in value at the same rate, what your money can buy in terms of goods and services will decrease over time. So what you would rather do is just save your money somewhere where you could get a return on it, a rate of interest. And so financial markets, and in particular banks, provide that service. So let's make some notes about number 1, facilitate saving. Individuals can save their money with financial institutions such as banks. It's considered a safe place to keep their money. For example, many banks are insured against losses, losing people's money, or making bad loans. Importantly, your money earns interest, which means it grows in value by a certain percentage. Okay, let's move on to lending now. Number 2, the second role of financial markets. So if you are lucky enough to have some money stashed away, saved, you will often save it in a bank. And this is how banks essentially work. They take money from savers, from you and I, and we deposit that money in the bank. Now, what happens when the money is in the bank? It doesn't just sit there. What the banks do is they take some of the money and they lend it out through loans to borrowers. Those borrowers then put it to some productive use and pay back the loans with interest. The banks can then give some of that interest back to us so that our savings grow. And so here we can see the clear role that banks play in connecting savers and borrowers. It'd be very difficult for me to lend my money directly to a business. I wouldn't know which one to lend to, which were trustworthy or not. So banks play this important role. I give my money to the bank and they lend it out. Now, how do banks make a profit out of this? Well, the interest rate they give to me on my savings, for example here 1.6%, is normally a lot less than the interest rate they charge on the loans. Here, for example, 4.95%. So the bank here is making the difference, 3.35%, as their profit. They're charging the borrowers 4.9 and giving the depositors 1.6. Of course, if you weren't happy with those rates, you'd go to a different bank. So let's make some notes on the function of lending. Banks are profit-making institutions that have a special place in the financial system. They connect savers with borrowers. Our example there, a bank receives a deposit and connects it with someone who is looking to expand a business perhaps or borrow money. This is important as the ability to borrow money and put it to productive use is an important source of economic growth. Imagine if you were a business and you couldn't borrow anything from the bank, banks didn't exist, it'd be very difficult for you to expand your business and invest. Okay, let's go on to number 3, the exchange of goods and services. Financial markets help us with this. Way back in the day, we might have had a barter system if there wasn't any money, where people just swapped goods that they wanted. But we know that's not a particularly efficient way of doing things. So these days, if we want to buy nice, luxurious cars, we use money. Now, if I wanted to buy this very fancy Bentley on the right-hand side here, and I had to pay with cash, I would be taking a lot of cash down to the Bentley dealership, a wheelbarrow full, or a good few wheelbarrows full. So instead, it's more likely that I would pay using a card or using some sort of digital service. And again, that will be done through a financial market, a financial institution. So let's make some notes on this. Financial markets can make the exchange of goods and services easier. Money can be moved digitally from the buyer's account, my account, to the seller's account, Bentley's account. Imagine if the system didn't exist, it'd be very difficult. We'd all be carrying huge amounts of cash around with us. But thanks to financial markets, this isn't the case. Okay, let's move on to a slightly more tricky one, and that is number 4, provide forward markets in currencies and commodities. Okay, let's imagine the scenario here where I am a petrol company. So I take oil and I turn it into petrol. Now, in 6 months' time, I want to be buying oil, and I might want to know how much money I'm going to need to spend. But actually, that could be quite tricky because the price of oil can go up and down. Now, how can I be certain about the price I'm going to pay for oil in the future? Well, what I might do is I might contact someone who works in a financial institution who is perhaps a commodities broker. I might ring them up and ask me to create a contract, what's known as a forward contract, where they guarantee me a certain price in the future at which I can buy my oil. The same is also the same for currencies. Let's say I know that I want to buy oil for dollars in 6 months' time, and I know I need $10,000. And if I'm based in Europe and I have euros, I don't know what the exchange rate is going to be in 6 months' time. If I want to guarantee an exchange rate in the future, again, I can contact my currency broker and ask them to give me a contract or give me a price for what it would cost to guarantee I could buy a certain amount of dollars in the future. So let's make notes on this and go through again the idea of a forward market, a forward contract. So but many businesses know they will need to purchase commodities or currency at some point in the future. So I might need to buy oil in 6 months' time. Or if I want to buy supplies from the USA in 6 months' time, I might need in 6 months' time to buy dollars, convert my currency, euros or pounds, into dollars. However, there is a risk that the price of commodities or the exchange rate may change in the future. A risk that as a business I don't want. I want certainty. I want to know exactly how much it's going to cost me. As a result, what I can do is enter into a forward contract. And this is an agreement with a financial institution, for example, someone who works as a currency trader or a commodity broker at a bank. And I can enter into a contract with them to buy a certain amount of oil or a certain amount of dollars at an agreed price on an agreed date. As a result, I have certainty and I have reduced my risk. Now, I might get a good deal, I might get not such a good deal. I don't really know how the price of the commodity or how the exchange rate is going to change in the future. But what I do know is I'm not going to have the risk that the value is going to change. So I'm happy. This is often called hedging. So like people hedge their bets, here the business has hedged its risk. It's kind of reduced its risk. Okay, number 5 is to provide a market for equities. So what do we mean by that, and how does financial markets help us? Well, let's imagine that I'm a business and I want to grow to become an even bigger business. Now, I could take out loans, but I have to pay back interest, or the bank might not lend to me. What I really want to do is just borrow from the masses. I want to borrow from the public. I want money from as many people as possible. Now, how do I raise money from as many people as possible? What I can do is I can sell shares, sometimes known as equities, on the stock exchange or the stock market. And the stock market is a financial market, a financial institution. So I can issue shares, create shares in the business, sell them to the public through the stock market, and I can get this access to extra finance. So let's make note on this last one. Many businesses want to raise finance to fund expansion or new products, but they might be reluctant to take out loans. Instead, they wish to sell shares, and a share gives whoever buys the share some ownership of the business in return for the price they pay for it. But how can I issue shares on a really large scale to the public? And the answer is through the stock market. This is a financial institution that facilitates the buying and selling of shares. And shares are sometimes known as equities markets. Governments can also raise money. They don't sell shares, but they do issue what's known as bonds, and they do that through the bond market. And in return for giving the government money, investors who buy the bonds are promised a certain amount of money, a repayment over a certain period of time. So in this video, we've looked at the different roles of financial markets, 5 different ways in which financial markets help the modern economy. That's it. Thank you very much for listening.